Hey everybody, this is Mike with Commercial Investors Group. Today I want to talk to you about how to structure a partnership. It's one of the things that was the most mysterious element of investing in commercial real estate that I just absolutely did not understand when I got started buying commercial real estate properties. Also, if you're investing in residential real estate, you might be funding your entire deal or most of your deal with hard money loans and things like that. But when you get into the commercial game, you most generally will need to have a money partner in order to get some of the deals done. So today, by popular request, I really wanted to walk you through how some of these deals are actually structured, walk you through the semantics of it. And the goal is you're going to come away from this meeting here understanding exactly how to go out and find a money partner in order to get your commercial deal done. So without further ado, I put together a little presentation that should help you hopefully think through your deal. If you have any questions along the way or whatever, if you're catching this on the live version, throw it in the chat. Otherwise, you can also just email us or schedule a strategy call when we're done, and I'd be happy to talk to you about your situation. So today's presentation, again, is real estate partnerships. I'm Mike Sowers. I own, manage, and have helped finance several $1 million in real estate. We have a passive income going that is pretty healthy for our business. And I only tell you all that not to impress you, but to impress upon you that the simple 20-step process that we teach can be repeated. It can be duplicated in any market in the United States. And so I want to jump into that today and specifically how that relates to the partnership stuff here. So first of all, our 20 steps rolls into 5 basically segments. It's how to actually find properties, how to get properties funded, how to fix the properties up, fill the buildings, and then create freedom. So our strategy is actually fairly simple. What we do is we find underperforming commercial properties, and then we use money partners to get the deal done. So we bring in an equity partner, and that's what we're going to really talk about today is how those deals are done. But I want you to see the bigger picture and how this relates to it. So today we're talking about just getting your deal funded and the steps that are associated with that. Then we fix the properties up, we fill the buildings with great tenants, and then we free up our capital and our time. And that's ultimately the goal, is that real estate, one of the cool things about it is that it can give you financial freedom. That's where your passive income meets or exceeds your monthly living expenses so that you can give up the JOB and you can spend your time just building that snowball, and you can take vacations and come back and have more money in your account than when you left. So ultimately, time is for most people one of the assets that they're seeking, and you just can't do that by giving all your time up for a regular day job if you're a W-2 employee. So let's break these down. We got 5 modules. And again, today we're going to focus on the fun, but I do want to walk you through. So it's a 20 steps broken into 5 modules. So the first module is how to find the properties. And the steps that we go through on that are how to identify what your buying criteria should be, and then how to actually create an Excel spreadsheet of properties that match that criteria. Then we go through how to gain owners' contact phone number and emails in a way that is mass, not just one-off. Then how to actually contact them through direct mail, phone calls, and some other creative methods we have. And then with the goal of setting a tour. Then we walk you through the process of how to actually tour a property, what you should be looking for. The 4th thing is how to gather the 5 key financial points, which are the 5 things that you actually need in order to analyze the deal. So sometimes not having a process you'll just kind of be spinning your wheels. So we actually have 5 very specific things that you need to gather in order to analyze the deal. And then we have a full analysis spreadsheet as well as a back of the napkin kind of analyzer. I can actually analyze a commercial property in our market here in about 30 seconds, and I can tell you if it's a deal or not. So if you've been looking at a ton of stuff and you're just kind of scratching your head going like, I wonder if that's a deal. I don't even know how to tell a deal, a good one from a bad one. You're not alone. I was in the same shoes. So I developed this process really for us to use. So this is the process we use day in and day out. It's always expanding and we're getting better. So I want to be able to bring it to you guys so that you guys in your market can, and gals, I should say, can really take this model and you can duplicate it in your market to achieve the kind of freedom. The sixth thing is structuring the offer. So after you've analyzed it, you should be able to figure out what is it worth when it's fixed up and filled up, and then how do we work backwards into what kind of profit do I need to make, and then how do you actually structure a few different offers, like a cash offer, a contract for deed offer, and a master lease. How do you translate all that? And I just have a tool that does that super slick for you. So in some of our other trainings, we're going to give you that tool. So today, I'm focusing on the fund step. Fund is steps 7 through 10 of our 20-step proven playbook. Step 7 is really how to underwrite the deal. I got it covered up here, but due diligence. You hear the term due diligence. Really, the goal of due diligence is to structure away as much risk as possible. There's always going to be some element of risk. Our goal is to go in eyes wide open. We want to be able to structure away enough risk. I have a checklist that we use for that. That's not today's training. Today's training is lucky number 8, how to actually structure your partnership to raise equity. So a typical commercial deal might be $1, $2 to $5 million for kind of a mid-sized deal. Sometimes you'll see smaller stuff, but let's just say for today's training that we're looking at $1 million property. So step 9 is us and our partners are going to go secure bank debt. The bank probably is going to give us like 65 on the super low end, unless, you know, most cases, I'd say 9 times out of 10, most of the local community banks that we work with are going to give us 70 to 75% loan to value. If I have a stabilized asset or something like that, I might go higher. If I'm trying to get debt where I don't have to sign on it personally, you're going to have to probably go lower, but let's just say 75%. It's a nice easy number. That's what most of our deals are getting done at, 75% loan to cost on the debt. That means that I need to raise on $1 million deal $250,000. Now, I don't know how many of you out there just have $250,000 sitting in your checking account burning a hole. If you do, go ahead and hit me up on a strategy call immediately, because we should be talking about getting your money to work in some of our deals if you want to be a limited partner. And I'm going to talk to you here in a second about the differences between being a general partner and a limited partner. Hopefully you can kind of decide which one makes more sense for you. So the next set of steps is the fixed steps. I'm just going to kind of breeze over these. Again, these aren't for today's training, but that's writing the scope, collecting the bids, awarding the contracts, and managing the schedule, quality, and draw requests. Then you have the filling, which is the media and listing package, how we're different than most all other investors out there and why our media packages are better. Generating leads for people that want to lease the space, showing it to them and signing the deals, understanding all the structures behind that. And then this is managing the property ongoing. So how are we going to actually drive the value and cash flow by managing the financials ongoing, and then recycle our partners' capital. So without further ado, I'm going to jump into partnership structures, which is step 8 of our 20-step process. So 2 partnership structures. There's the fund structure. That's what I'm going to focus on today. And then we have a joint venture. So what is the fund structure? The fund structure is where you actually set up 2 separate entities. One is called the general partner, general partnership. They're often referred to as the sponsor. This is the active partner. And then there's the limited partnership. So let's walk through the roles here. So the general partner is the managing member of the property. They're going to do all the quote unquote work. They sign on debt. They generally have to put up a personal guarantee, and that's the person who manages the asset. So what is all the work? Well, that's finding the property, structuring the partnership, fixing the problems, filling the vacancies, and managing the financials ongoing. So that's everything we just went through in our 20 steps. All of that is the responsibility of the general partner. The limited partner is actually who takes title to the property, puts up all the capital. They generally, though, have limited liability, which is a key thing there. They do not sign on debt in most cases, and they don't do any of the work. So they are truly a passive partner. The max exposure they have is their capital that they've contributed to the deal. So general partnership, limited partnership, sometimes you'll refer to this structure as the fund structure. This is the most common structure for how commercial real estate deals are getting done. So that's a little bit behind the scenes, but let's break it down even further. By the way, there is another one called a joint venture. That's where like two general partners do a deal together. They would both sign on debt and then they kind of agree to who's doing what. So if you ever hear the term like joint venture or something like that, I do see a lot of people in our market putting together a fund, but they're disguising it as a joint venture. Again, the key difference here is in a fund, you're going to have a limited partner who has limited liability. They put up the capital and they don't do any of the work. If you have one of the partners in a joint venture who's putting in the capital and they're not really doing any of the work, you really have a fund, which does require some additional disclosures and things like that. You don't have a joint venture, but a lot of people are using a joint venture title on something that really should be a fund and have all the disclosures of a fund. How does the cash actually get distributed? So what do I mean by I'll give you 8% on your cash and then we'll split the upside? So here's what I mean on this. So let's just look at cash flow from operations. So this is something called the IRR Waterfall, and it's just kind of a, how does the cash get distributed? So I had my little infographics person put this together. It's not perfect, but I think it displays the point quite nicely. So cash flow from operations is monthly rental operation income. Cash flow from disposition would be if we ever sell the property. So the first waterfall here is cash flow from operations. Let's just focus on that. So I have rent income that comes in. The first thing I do is I pay all my taxes or all my operating expenses. So that's taxes, utilities, maintenance, management, insurance, repairs, and admin. Then I pay my bank loan payment. So I make my mortgage payment on my commercial property. The next person that gets paid is my limited partner. They get a preferred return. In my last example, I said 8%. So if we bought $1 million building and I raised $250,000 from my capital partner, my equity partner, and I got $750,000 in debt, and I said, hey, on your $250,000, Mr. Partner, you're going to get 8% per year. So if you run the numbers, 8% of $250,000 is $20,000. So the first $20,000 after the bank gets paid goes to you before I get a penny, and then we have some kind of split or agreed upon split after that. Now, how that split looks may vary depending on your agreement. The most simplest form is you just do one level. Hey, we'll split every dollar after you get 8%, 50-50. That's how a lot of deals are done. That's actually how we're doing the majority of our deals. We just say, hey, cash comes in, I pay all the operating expenses, I pay the bank, I give you 8% per year on your money. In our example, it would be 8% of the $250,000 or $20,000. The first $20,000 per year goes to the partner, and then we split whatever's left over. Some people will do this waterfall. The waterfall is where it would be different tiers. So you're in blue here, most likely. You're the general partner. So the first 8% goes 100% to the limited partner. That's this preferred return. Then the next dollars from 8 to 10% get split 30% to you, 70% to your partner. Now, again, this is just my example. Then I have from 10 to 15% going 50% to you, 50% to your partner. And then at 15%, 70% to you, 30% to your partner. So the first example I gave was 8% to your partner. We split everything after that 50-50. The second example over here is where it's tiered. So it's the first 8% to the partner, but then I only get 30% from 8 to 10, 50% from 10 to 15, and 70% from 15 plus. Now here's what happens. This is much more complicated to sell, right? And the confused mind generally says no. So if you're a beginning investor and you're looking at the IRR splits here and your head's spinning and you're going, what is he talking about? What's an IRR and all that kind of stuff? That's okay. Just forget about that. Think of it like this. Your partner's going to put up some cash. You're going to compensate them. They get an 8% return on investment before you guys have any profit. Once they get their 8%, then you split the profit with somebody 50-50. That's the easiest way to think about it. And that's how I would structure your first deal. And part of our program is a lot of these books out here, they give you, hey, here's 17 different ways to structure the partnership. I have a lot of them. You have the rake, you have the IRR waterfall, you have a plus promote, you have net investor proceeds. You're going to hear different terms like IRR clawback and GP clawbacks and all these different things that are these fancy terms that people use to try and make these things overcomplicated. My goal in our program is to simplify things and to not give you all the different ways to do a deal, which just leaves you more confused than ever. I'm going to give you the way that we're doing the deals, which I found to be the best way at the time, my best understanding, but I'm not perfect. But I will tell you that it does work. And if you just follow that one specific playbook, all 20 steps, we give it to you specifically, you'll buy a piece of real estate. Cash flow from disposition would be when you sell. First person to get paid off would be the bank. Then any past due preferred returns would get caught up. Then you would give them their upfront money back. Then you guys would split it however. Now, generally at sale, this is maybe where you're doing the IRR splits. So it might be that, hey, as we hold this thing, you're going to get 8% plus we split it 50-50. But then when we sell it, you get your money back and then we're going to split it based on these buckets here. So sometimes we're doing that on the back end where if we're incentivized, the higher the return that we provide, we get more of the bucket, if that makes sense. So we're incentivized to drive higher and higher returns. So you might be thinking like, well, that sounds pretty good for the general partner. They don't put in any money and they get half the profit. Well, yeah, but they do all the work. So do you want to be a general partner or do you want to be a limited partner? Just being a real estate investor is a pretty vague term. You got to figure out, do I want to be the active person doing all the work, or do I want to be the limited person putting in the money? If you're answering you want to do both, then you may not need a limited partner. If you want to be a general partner, but you also can self-fund your deal, that's awesome. But not everybody is in that situation. So let's walk through kind of general partners. If they raise money from limited partners, they can do larger deals. They can do more deals. Generally, they charge an acquisition fee of like 2%, sometimes as low as 1%, sometimes as high as 3%, but generally we see about 2% of the purchase price as an acquisition fee for finding the deal. And they're responsible for creating the value and creating the cash flow. So they get equity growth and cash flow growth. With our model of value add, we're targeting properties that we can force appreciation in. So we're creating a lot of value in those properties. And then a lot of times what we'll do is extract our limited partners' equity out to pay them off. And then we stay in the deal and we're getting cash flow on equity that we created. So we actually would have no cash into it and have a monthly cash flow. And that's when things get pretty exciting. From a limited partner, like why would a limited partner do it? Well, the biggest reason is they have access to deals they wouldn't otherwise have access to. The other, I guess, big reason why a limited partner would do a deal is the returns. The returns are phenomenal. In our market, our limited partners are getting returns, as low as 10% and as high as 22%. So they're getting, I would say, above stock market type returns, but actually having an asset that they can touch and feel. And some people just like to diversify and they like to have some real estate in their portfolio. Another big benefit for the limited partners is they get their proportionate share of the depreciation. So not only are they getting passive cash flow through distributions, but they're also getting a tax write-off. So for high net worth doctors and lawyers and things like that, I think if you don't have a huge network of people who have, $1 million sitting in a checking account somewhere, don't fear, but I will tell you this, that they are out there. I didn't know them all when I got started, but it's kind of like you build it and they will come. Like if you follow a process to actually go out and find a really good deal, I can show you how to get connected with people that will invest in that deal with you. So hopefully this just sheds a little bit of light on how to actually structure a partnership. If you have some capital you're looking to get put to work, or you're thinking about learning how to become a sponsor and actually structure deals by raising money from other people and stuff like that, I'm happy to talk to you about your goals. I invite you to schedule a complimentary strategy call here at this link. It's just calendly.com, Mike6278/strategy. And best of luck investing to you out there. And we have some other content that's complimentary on our podcast, the Creative Commercial Real Estate Podcast, as well as our YouTube channel if you just search for Commercial Investors Group. Thanks for checking it out. Hopefully today's session was helpful.